going to begin recording now. And I'd like to welcome you to Ben Franklin Venture Investment Forum's inaugural Capital Call Meetup. I'm Jill Edwards, the Executive Director. This is the first in an anticipated quarterly meetup with Angel Group organizers and early stage VCs in the Mid-Atlantic region. As I mentioned, today's session is being recorded, and I will send you the recording after today's session, so you may listen to it later to refresh your memory. As we go through today's session, please type your questions into the chat box. When we've completed the presentation, I will pose your questions to our guest speaker until we run up against our hour deadline. Now I'd like to introduce Brian Slaywin, Ben Franklin Portfolio Manager for Northwest Pennsylvania. He's going to moderate the discussion with our guest speaker. Brian, go for it.
Thank you so much, Jill, and good morning and welcome, everybody. As Jill mentioned, I'm Brian Slaywin with the Ben Franklin Technology Partners in Northwest Pennsylvania, with our offices right on the Penn State campus in Erie. And we're pleased and very excited to welcome today Catherine ONeal, who is the Executive Director for Jumpstart New Jersey Angels, a member-led angel investor group that invests in early-stage companies in the Mid-Atlantic region. She is an investor in early-stage companies herself, and she serves on the board of the Angel Capital Association and was the chair of the ACA National Summit this past year in Philadelphia. Catherine represents the ACA at both national and international events. She is a speaker at many early-stage investor and entrepreneurial events and has been quoted in numerous publications, including the Wall Street Journal and Forbes. And she started this great entrepreneurial journey by earning a bachelor's degree from the University of Maryland in economics and a master's degree in economics from the University of Pennsylvania. So Catherine, welcome to the Venture Investor Forum Capital Call.
Good morning, I'm happy to be here.
Why don't we start with one question, and then I know you have all kinds of information that you'd like to share with our group. The first question is probably the easiest question. As a seasoned corporate finance business executive with a background in the chemical industry, among other things, how did you get interested in angel investing?
I think I was really lucky to come out of grad school and go into businesses where I was at a group level or a corporate level. So I got to work with all different kinds of businesses, and it gave me a real feel for different models, different behaviors. And I feel really lucky going into the chemical, I was agriculture, chemical, general chemical business with FMC, because that's a company that you have competitors, you have to meet margins, you have to make decisions fast, you have to be knowledgeable about your markets. And I learned an awful lot there, and then was recruited away to what's now GlaxoSmithKline in corporate. So I got to see the world at that point. So a lot of international businesses, a lot of different kinds of businesses. Pharma businesses are device businesses, they're drug businesses, they're all sorts of businesses these days. And so that gave me a great issue for models and how things work. So I sort of, as a financial person, I always feel, if I know how these things work, I should know how it's going to behave in the future. So I got great education domestically, internationally, corporate and operational divisions. So I thought it was I think it's a great thing that you don't necessarily have these days as people move into smaller businesses. So when the financial group corporate financial group went to the UK from Glaxo, I thought, I'll work for another pharma company. And but then someone came to me and said, here's an acquisition. And I said, piece of cake. I've done acquisitions and M&A work all the time at corporate, and started doing work for fundraising and working as interim CFO for small organizations and raised fundraising, which was a beginning part of this part, because everybody's seeking funding, correct? Yeah, absolutely. So it's a great skill to have. Then was recruited at one time to start working with, I was doing a lot of CFO work, recruited by the Tech Council, who was forming an angel group. So started with them, and I still do work part-time for the angel group, but we've really changed what we've done over the past several years, because Jumpstart's been around almost 15 years now.
So, as the executive director for Jumpstart New Jersey Angels, what do you do on an everyday basis? And even more importantly, what do you look for when a growth or early stage company is approaching you and your organization?
I do a lot of work, sort of outreach work, letting people know what Jumpstart does, because everyone will ask me, even people who I've known for many years, saying, Jumpstart invests outside of New Jersey? And the answer is we've always invested outside of New Jersey. We're thinking about changing the name finally, even after all these years. We're mid-Atlantic investors, so we want to be close to the companies we invest in. I mean, early stage companies need more than dollars. They need assistance, they need doors open, they need help in ways that more developed companies don't need. So that's why we stay in our region. Very rarely do we ever go out. So we see lots of deal flow. We see lots of deal flow from syndicated angel group and VC partners. And what we're looking for is somebody who's going to be disruptive, somebody who has knowledge in their space, and someone who understands sort of like the tough road it is to move forward on an early stage company. And is also, you hear that word, coachable. We all don't have the answers, but if we listen to a lot of people who've done something before, have some answers, we need to sift through that and take some good advice. And sometimes that's hard for people to take.
So I know if you go on to your website at jumpstartangels.com, there's a little button that says apply now. So once I hit that magic button and start filling in the form, then what happens? And then ultimately, how long does it take till I get a check, if I ever do?
When you apply, Jumpstart has a monthly meeting, except in August. So we're looking at that as a deal flow source, as well as referrals from other investors, other companies, lawyers and accountants. I can't say how good lawyers and accountants are good as to help represent an early stage company in this environment. We have those. We filter everything now on a platform called Procedure. So you have to put your information into Procedure. We're looking for something that describes the shape of the business, not just how wonderful your technology is, but what is the business like? What are you going to do with this? So you have this wonderful shiny object. What does that mean? How much is it going to cost over the next few years to launch it? How much expertise do you have in this space? Is it building a brand? It's difficult. I will say that Jumpstart does not really invest in three areas. One is food, one is fashion, and the other is drugs. Because the length of, coming from that background, you'd think I would be interested in it. You can't call it, okay? It's very hard to call the timing on a drug or the last VCs in on it. Long process, lots of risk. So we don't have a lot of pharma investors. So we sort of stay away from those three areas, and we're totally fashion impaired. Trust me. There's no one fashion forward in Jumpstart.
So food, fashion, and pharma, everything else you're open to.
Yes. We do we do invest in a lot of pre-revenue companies. We do want some traction now, a beta test, some revenue. We do like, if you have revenue, we'd like that. It shows that some customer really wants what you have to offer.
So one of the interesting things about the Ben Franklin Technology Partners is we look at early stage tech companies as well as small manufacturers.
Mm-hmm.
And I know, much like us, we love all of our children. So it's hard to say that company was a superstar. But if you can, share with us some of the really more interesting companies and or market segments that you've seen lately that you're starting to have your members invest in. Do you see any trends happening in terms of what you're seeing coming to you? Your members are leaning one direction or another?
We have a lot of engineers in our group, so they like things you can touch. So we do like this IoT, move Internet of Things, the sensors. We recently invested in a sensor company out of Baltimore, or excuse me, College Park, Maryland. And we're on there for the follow-on rounds, which I think is important when you have an investor. Investors, there are some investors who are one and done. That's their model. But Jumpstart, if we come in and you hit the goals if you're supposed to be doing, we're going to be in there for the second round and the third round. So we really stay with the company. I would say sensors, we certainly like. There was a big change in AI these days. So everyone is doing artificial intelligence to either sift data, to be able to turn around and create chatbots, to be able to automate things that were not automated before. So big changes. Fintech's being disrupted. What millennial is going to talk to a financial advisor when they can do it all online with really good tools? Until they make all their money when they sell their business and they really want hand-holding for that exit. So I think, I mean, we're seeing that. There's always a lot of consumer-facing innovation, but Jumpstart doesn't, we do invest in some consumer-facing businesses, but the cost of creating a brand is very difficult. It's high, takes a lot of money, so it's generally not in our interest. We're not directly consumer-oriented.
So as you evaluate a company and present them for potential investment, we've always heard you bet on the jockey, not necessarily the horse, but you still have to have a pretty decent horse.
Mm-hmm.
As you're looking at the team, what kind of things do you look for? What kind of things do you look in the makeup of the principals, say the 2 or 3 people who are really driving the company forward? And then what do you look at when it comes to evaluating the bench and the people who are doing maybe the more operational and hands-on day-to-day? How do you look at teams and kind of what do you look at or for?
Well, all investors like a serial entrepreneur who's done it before, who's learned their mistakes on somebody else's money, okay? Or maybe made some successes on somebody else's money. And a lot of times, especially in this space, we're seeing technology founders. So they're missing some skills in sales in other places, and they have to be aware of that. And someone who is, pivoted, everything changes. Whatever path you direct right now, or whatever business plan you write, it will change. So can you deal with that? Can you respond in a way that enhances your business rather than becomes a real stumbling block? The team itself, what we really like to see is, can everybody on the team sell? We have 2 or 3 people maybe on a team in the beginning, and also too, there's another trick that some of your companies should be aware of, especially now with accelerators or when people are pitching as a team. You want to ask the random person, not the CEO, what's the pitch of the company? Okay, how do you describe this company, and what does it need right now? Where is it going? 3 sentences. And if that person can't do it, if it doesn't have the vision of the thing, that says the team is not integrated. So I think that's important. And then with distributed teams now, we know that there's a lot of developers in different locations. That's fine. I mean, you're using development as a tool, as long as you have a strong technology person in the company. I sort of bounced around on that answer, but I hope it helps.
It absolutely does, and it kind of leads me into maybe 1 or 2 of the red flags that you see when a company is doing their presentation or in their documents or just sort of the way they walk the earth. What are a couple of the red flags that you want people to be aware of and be sort of working on and tuning up?
I think there's 2 ones that come to my mind, which happen all the time. First one is if you say, I have no competition, and people still do that, okay? They'll say, or, I've got 10 little check boxes in my product qualities, and these companies only have 2 or 3. Well, maybe companies only want to pay for 2 or 3 if you haven't done enough customer research. The other thing is a company CEO or presenter who doesn't listen to the question or will give a long, detailed answer as opposed to yes or no, or yes, bang, 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 as opposed to building the castle all over again. So they've got to listen to the entrepreneurs, because people are asking questions because they're trying to hone in on the shape of the business and where it's going. And the details can follow in later discussions, but where is it you're going? Can you describe that? And if you cannot describe where you're going, that's a real red flag too.
Yeah. And so with your organization and a couple of the others that you've recently founded and been involved in, there's a process, there's a website, there's a button, and that gets that person into your deal funnel.
Right.
What happens, or what's the best way for an entrepreneur to continue to build relationships outside of your organizations with individual investors? They happen to know a couple of people that are maybe in their space. How would you, I've got an idea and I want to eventually get some venture investment into the company because I think it'll help me in a variety of ways. What's the best way to foster and develop relationships with investors?
I think ask for advice before you ask for money. I also think that one of the best ways to network in this community, which is a very welcoming community, is with your accountant and your attorney. And I can't emphasize enough that you have an accountant and an attorney who operates in your space. If you're high tech and high growth, you need somebody who has those connections. You may think you're paying too much for your accountant and your attorney, but they can open doors that you can't. And I think that's a very valuable resource. Advisors, people who you can go to and ask questions in the space. I think they're very important. And I also think that other entrepreneurs are very helpful too. I mean, we have an event where we have 10 to 12 CEOs of early stage companies in for a drink, and we tell them while they're waiting to talk to us, network with the other companies here. They may know somebody that you need to see. You may know somebody that they need to see. It's a very, I think, welcoming environment. So don't forget the community. So if you're isolated in your own cell and think that's important, you need to get out there to the meetups, to the Ben Franklins, to all the other groups that are around.
And sometimes I hear that entrepreneurs only approach investors when they think they're ready or when they're raising money. Would that be the approach you take, or do you like to know a company's story very early with frequent sort of touch points along the way, even well prior to them raising money?
I've met companies who keep me in the loop on what they've done. They may be too early for us to look at when we start talking, and then they tell me what they've done, and they've done some other things just in short emails. I think that's fine. Okay. And then you say, oh gosh, they've really accomplished something. Maybe it's worthwhile to bring them in to do a pitch or have a drink. I think that's really worthwhile. But also too, I think companies really need to listen. Like if someone says, we've never invested in this space, okay, I can maybe send you to somebody who does, but we don't do it. Don't, I'm saying nicely to you, don't bother me anymore. But somebody who doesn't invest in your space may be a source of referrals to some other people, but they're not going to be the people that will ever turn around and love you just because you're in that space. Okay, I know several entrepreneurs who I think are great entrepreneurs, but I hate the space they're in. So it's not going to do them any good to keep talking to me, trying to get me to love their company.
So just as a reminder for everyone in the room, we're talking with Catherine ONeal, who's the executive director of the Jumpstart New Jersey Angels. And if you have questions or would like to get your thoughts and share some ideas, or have Catherine share her ideas about your questions, by all means, make sure that you enter those questions in the chat box, and we will be addressing all of those here in just a little bit. So Catherine, you've recently founded a new angel group based out of Philadelphia called the Philadelphia Angels. What a great name. Is that the right name of it?
No, it's Broad Street Angels.
Okay. Broad Street, sorry. So
okay.
Different investment philosophy, potentially different people. Why another angel group in this area?
Because it's more capital from a different source. The Broad Street Angels was created because I'm on some advisory boards for Ben Franklin in Philadelphia. And we were having a discussion with some angels around the table, and 2/3 of them were Broad Street or were Union League members. Broad Street Angels is a subsidiary, not a subsidiary, but it is formed from Union League members only. So a lot of people who don't have connections to the early stage investment area but want to. So it's actually a new source of capital for the region. So Broad Street Angels invest in the Mid-Atlantic region also. So I'm one of several co-founders to the group. The group has been open for business since February, having companies present, and has already invested about $500,000 in a couple of deals. So different investors, new money for the region, and new levels of interest. Now, Broad Street is still figuring out where its sweet spot is in terms of what they're really interested in, what they're not really interested in. But they have a monthly meeting also too, with 3 companies presenting.
And so do you always invest as equity? Do you sometimes invest as debt? Is there hybrid versions that you take? What's the preference? What's the member's ideal scenario?
Jumpstart's preference is a priced round, so directly as far as equity. And there's a couple of reasons for that, and there's actually a couple of good reasons for companies. If people are not familiar with the qualified small business tax laws, which allows if a certain kind of stock in a certain kind of structure is held at least 5 years, there's no federal capital gains if it's sold after 5 years. Different states. New Jersey, unfortunately, does not exempt it from capital gains. I believe Pennsylvania doesn't have the capital gain on that. But you can't decide whether or not you're going to get out of a deal in 3 years or 5 years. So it's just if you're in that structure, you have the opportunity. A convertible note with a cap is okay, but no one really feels happy saying, okay, if this is a cap of $3 million, I'll get a 20% discount, but here I am putting my money in right now to let you get to that valuation. So I don't want to be compensated with a 20% discount or a 10% discount. I want to have a price round now so I can be compensated fully when you get to that level. You've heard of safes also, which is at least at the Jumpstart level, we absolutely despise them. Yeah, because it's a promise to have an investment. It's not even a debt or an equity note. So, and theoretically, you can actually have that note, and the company could go public, and you would never get money. Okay, it's a strange hybrid. It's a way for VCs to do deals easily, without having to negotiate a value. And then if early stage VCs are just throwing $100,000 at different companies, expecting one of them will pay off, and the other ones that don't, they won't follow on with. That's what it's for. To me, I call it a ticket to ride. A ticket to ride for the next level.
So the term SAFE is actually an acronym for the Simple Agreement for Future Equity. It's, as Catherine described, it's an easy way to buy a ticket for future opportunities to get on the ride when there's actually something there. Those have become kind of popular, maybe more so on the West Coast. You're not seeing them more so on the East Coast, or is it sort of angel groups in general don't like the safes?
Most angel groups don't like the safes. Actually, it's still West Coast phenomenon. You'll see them try and drift to the East Coast, and if somebody hands me a safe, we just laugh. Okay, we're the first ones in, or we just say, "Hey, this is not interesting ploy," but no. Okay.
Yeah.
I mean, that's if we're running in terms. Okay.
Yeah. Do you see a difference in the way West Coast investors look at companies versus the way East Coast, which is obviously your area of expertise, but in terms of West Coast, East Coast, differences, what they're looking for, what they're willing to invest in, various metrics, what do you think the geographic view is between West and East Coast investors?
I think it's still a sort of sprinkle of money around and see what happens on a lot of different companies. But they're also in the West Coast more really focusing on high growth and can be consumer facing businesses. Okay. Right now, what's happened on the East Coast was there's always been a hub of healthcare in Boston. Then New York has really become a fintech hub, as well as some AI. So there's a little bit more specialization. But I think, and New York has always been the media center also too. Philadelphia has a bunch of, I think, a bunch of good software companies, and it still has a really growing, healthy community too. So I don't think they're hard to emerge in terms of the East and the West philosophies. It's just that one takes more of a risk, I think, but over a larger, there's more money on the West Coast. There's no doubt about that.
Yeah.
But the Angel Capital Association has put out a lot of statistics which talks about where angel money is, and believe it or not, there's a lot more in the Midwest, and it's certainly concentrated now on the coast between Boston and I would say VC. I mean, we have a really sort of good ride there.
You know, I just was going to ask you some questions about the Angel Capital Association. What are some of the trending topics in the angel investment world relative to, you know, what are angels talking about when they get together and there's no entrepreneurs around? What are they talking about?
Exits. It's real simple, exits. It's still hard for early stage investors to have an exit with any period of time. There's a lot of discussion of structured exits where people are taking out, if there's cash distributions there from the company or expectations of change, they have in the term sheets rules for the investors being paid also at the same time as money is taken out of the company. So people are looking in a way as to be able to get out. I mean, 7 to 9 years is not uncommon right now still for an exit for an angel investor, or even longer.
And so you kind of, as an investor, you sort of have to be able to hold your breath that long before you can recapitalize that investment.
Well, you know, the rule, why everyone says, well, why do you have to be a accredited investor?
Yeah.
All it says is that you can afford to lose money.
Yeah.
That's truly what the rule is for. You can afford to lose money, right?
Yeah. So we're going to start addressing some of the questions in the chat room here in just a couple of minutes. They are starting to pile up, but it's not too late for you to get your question in as well. We're talking with Catherine ONeal, who's the executive director of the Jumpstart New Jersey Angels today. And if you do have a question, by all means, let us know, and we'll address those here coming up in just a couple of minutes. So Catherine, greatest success you've had the pleasure of being an investor in or seeing as part of your groups, not necessarily in the multiple, although those are fun, but just the greatest success story, someone you met when there was 2 people in a basement with an idea on a napkin, and then suddenly they're the kings and queens of industry. Can you share a couple of your great success stories with us?
Sure, and I'll add a comment on that too. I think we are in this environment where we see people from when they start, especially in the Philadelphia, New Jersey region, from where they start to where they move ahead. And there's lots of entrepreneurs who were in spaces not necessarily that were exciting to jumpstart or that we didn't have an interest in, but people always help each other. And I think seeing the growth of some of those companies doing really, really well, finding the right niche, finding the right customer, it's just really good, no matter whether you have money in them or not. You're always welcome. You're always happy for someone's success. Okay, and I think that's part of this community. An interesting company that Jumpstart had recent. Any time an exit happens real fast, unexpectedly, that's always a good deal. Okay, and we invested in Jumpstart invested in a gaming company, which was a daily social crossword puzzle. Now, we weren't puzzle aficionados, but we do read the metrics, and the metrics were great. The entrepreneur was adding users to the site, rapid fire. You could give him $1 million and he would add 2 million users, whatever it was. The number was going up. So within 2.5 years, the company was bought by a very large gaming company, add anything with a Z to it. And it's still quiet, okay. And and what they were buying, you know, this is part of also too seeing what you really have in value. They weren't buying the company per se for the puzzle business, which still goes on and is still important. They were buying it because they could convert all of those users to their other businesses and other games and other revenue streams. So, you know, people think it's about the shiny object, and sometimes it's about the value of the users of the shiny object, which I think is getting bigger and bigger these days. I mean, if you can roll up a user-based business, that's really important to someone who has other businesses to feed.
Yeah, you know, you and I talked, I was lucky enough to talk to you the other day. We talked about the variety of assets that a company actually has that ultimately build up to the exit valuation. And one of the things that was really intriguing to me, and we talk about it with the Ben Franklin Technology portfolio companies all the time, money comes, money goes, but it's the coaching and the networking and the sort of wrapping around a company, all of the support. I know that's a very active part that we have at Ben Franklin through our transformation business services. Angels are not necessarily VCs, and I know that your group especially really likes to roll up their sleeves and kind of get in there with the entrepreneur. That's clearly a critical part in the success of any company going forward.
We really firmly believe that if we can't add value through expertise, history, things that we know, and connections to a company, the group is not going to invest. Okay, and then it's the money transfer, and what can we add for value? Nothing. And so the value to the company is really in the expertise that your investors can bring. Now, sometimes, yeah, you're desperate enough and you just take the money, all right, as a company. But if they can't open doors, you've gotten no value from your investors. So that's important for a company to make sure that when they're getting investors, they're getting someone who can help them expand and grow and really move the company forward. Otherwise, it's just money, and you can get money from anybody.
And that brings me to my last question before we jump into the questions from our chat room. Why would anyone want to take other people's money? What are the advantages of getting an investment versus just bootstrapping it and doing it on your own?
Some things you can't bootstrap easily. The cost is too high, and unless you come in with a trust fund yourself, you may not be able to do it yourself. The other thing too is the rapidity of growth that's needed in this market requires you to sort of put a lot of front level money into a deal to make it grow fast enough to be of interest both to customers and to investors, as well as some exit. And so in your mind, you've also got to start thinking about it. Doesn't mean this will be the exit, but who's likely to buy this? Why is my business or product going to be really valuable? Who is going to buy my company? Because you don't make, and the angels don't make any money until the company is sold. Now, there is that issue of the lifestyle business, which nobody wants to invest in. Okay, but you have to realize that exit is driving everybody's investment.
Great. Catherine, thank you so much for spending some time with us so far this morning. I'd like to turn it back over to Jill Edwards, who is the Executive Director of the Venture Investor Forum, part of the Ben Franklin Technology Partners Network. And Jill, why don't we start addressing some of those questions that our chat room guests have posed so far? And you're still on mute.
Okay, now I think I should be unmuted now. Okay. Yeah, we have had a number of questions, and some of them were being asked by a number of people. So I'll kind of synopsize them and ask Catherine to respond. First of all, just to let everybody know, we will put Jumpstart's website on the email where we send out the information about the recording, so you'll have that. The first one was just a little clarification. You had mentioned early on the term consumer facing. What does that mean to you, Catherine?
That means when I'm talking about investment, consumer facing to me, if you have to build a brand from scratch, to me that's very expensive. It's very expensive. You have to put a lot of money into it. You've got to be able to spend it. And that's an area that Jumpstart just isn't particularly interested in. Okay, so we're not doing fashion, we're not doing food. We'll do companies that are enabling services in those places, are making it easier to do something with it, or can build a brand by being part of another organization. But to go out and create a brand from scratch, look at Birchbox. Okay, Birchbox is a really well-known monthly subscription service with women's cosmetics and products, and have just opened a men's Birchbox. The cost of taking that Birchbox was phenomenal, multi-millions of dollars, which early stage VCs invested in quite heavily. So I don't know what they've invested to date, but it's a lot of money. So that's not the kind of deal that we're interested in.
Okay, thanks. The next question is, what kind of deal size do you look at? Is 200,000 too little? 2 million too much? Can you give the audience some kind of a order of magnitude understanding of what you consider right for your group or groups, really?
Okay. Deal size can mean two things. Deal size can be the size of the investment. Deal size can also mean the size of the valuation. So Jumpstart is on average, we do $200,000 to $300,000 in a first round. It could be higher, it could be lower, because in Jumpstart we invest with individual checks, and so maybe only 3 people are interested. Maybe it's $100,000. If it's more people, we also do up to $1 million on a round by ourselves at our own table. We've done that multiple times. Just depends upon the business, the growth rate, what's going on. So the average is somewhere 200 to 300,000, and then if the company is performing and hitting its markers, then when they're coming for the next round, we're going to be in for that next round. So we'll do follow-on. So by the time you get to a couple rounds with Jumpstart, you've got $600,000 or $700,000. But it all depends upon are the customers coming in, if you hit your development markers, whatever the key things are. And the other question is valuation. We're not investing in a company in a no revenue early stage at a $10 million valuation or a $5 million valuation, unless there's some kind of real asset or patents with the business and it's really technologically focused. So we see most of our businesses are 3 million or under in terms of valuation, but saying that we've done multiple deals at higher valuations and A and B rounds also too. But our sweet spot is really early stage, some traction rather than no revenue.
How do you work with companies that are in patent pending state as it relates to their intellectual property?
It totally depends. I mean, I'm going to use one of my favorite terms, which is trash patent. Okay, that many economic development authorities in different states require to get funding from an entity that the company has a patent. Okay, and the patent may be totally irrelevant to what they're doing. It may be something that's really so old it's useless. But if the company doesn't have a patent, they can't get funding from the state organization. The patent pending piece also too, it could be important, and we have several members who really sort of focus on patents. If it's important and it's meaningful, then it's worth something, and we'll take a look at that as part of the discussion. But patent pending can take a while. So we like them if it's something worthwhile. We also recognize there's a lot of ones that are just sort of like noise.
Okay. When companies are coming to you, because they're coming from all kinds of different technologies, and you mentioned there are 3 general areas you really don't look at, but beyond that, there's lots of different kinds of companies. What level of specific or general expertise do you or your group feel that they need to have within the group about that company, that technology, that space, that is the minimum for you really seriously considering the deal?
Sure. We have expertise in fintech, because we've had people in those businesses either developing businesses and selling them, and knowledge of that space. And fintech is a hot market right now these days. We certainly have expertise in a lot of engineering products and chemicals and polymers. We have expertise in supply chain management. We have expertise in shipping. It's really diverse. A lot of software expertise, a lot of general expertise in a lot of businesses. Some people have been in funds before, so a wide range of expertise. But I mean, are we investing in chemicals? No. Are we investing in perhaps sustainability businesses? Yes. Okay. Just depends. It literally depends upon where that product is or where that company is in the space. So, and lots of supply chain stuff out there these days too.
Okay, thanks. I've gotten questions from a number of the participants about their specific industry sector, and do you have an interest, does your group have an interest in possibly contemplating them? How would you like us to handle that? I'm presuming probably I can email you that information privately, and you can reply back, or how would you like to do that? Or for general purposes, is there a place on your website where you can provide that kind of feedback?
Not really on the website. You can email it to me, or if it's sort of like general spaces, if it's IoT, things like that, we can say yes or no. It's totally up to how you want to handle it.
Okay. For those companies that have received early stage funding from you, and maybe they're at the point where they're looking for follow-on funding, and it may be of a dollar amount that's beyond the scope of your group. Can you talk about connections that you have with VC groups? How you handle assisting your portfolio companies to get the follow-on funding they need, and what kind of success have you had in that regard?
Sure. We're very networked into the early stage VC as well as some later stage VC relationships. They send us deals that are too small for them. They network us in and bring us into deals that have additional partners. So we have great connections, and it's to our benefit as much as it is to the company's benefit to make sure you get the right introductions to later stage funders. Okay, and I think that's really an important job. This is the thing about bringing connections to an investment, not just dollars. So we gladly do that. We gladly do that and bring them on to that and syndicate them with other angel groups also too.
Okay. The next two questions are sort of somewhat related in that they're both dealing with financial information, the financial part of an investment. First of all, is how do you value a pre-revenue company? And the second is on the company side, how do you develop projections that investors can feel confident about?
Okay, let me take the last one first. We all recognize as early stage investors that the numbers you give us will never occur. Okay, and they'll never occur for a number of reasons. Timing can be dragged out, all sorts of other things change, but they're your best estimate of what you expect to happen. So even though if you say they're very conservative, it's still the best estimate. The key thing is what a financial forecast says. It shows your thinking. Okay, so if you say I'm going to start releasing these products, somebody this month, I expect a hire salesperson to take this on. Essentially, it's showing us how you're going to manage and roll out the business, and that with all those assumptions for the financial forecast, that's really important. What doesn't look right to us in a financial forecast is I'm doing a 20% a month increase on all my sales, and I'm going from 0 to $2 million in sales in the next year. Okay, and that just does not happen. There's no way it happens. It doesn't really even happen from 0 to $1 million in sales. So you have to have something that's really credible. So you do the best forecast you can with assumptions, and that's what investors will test out. Well, why did you make an assumption of 15% or 20%? We see you still haven't hired any salespeople on the forecast. We're trying to see how you're thinking about moving the company along, and that's what the forecast is for. To go back to valuation, some people try and say my company is going to have $50 million or $100 million sales in X number of years, therefore my present value is X. It doesn't work. Your company is worth X today based on either your technology or what you've achieved and the expectation that of a forecast that seems reasonable. So most early stage companies without revenue are somewhere under $3 million in terms of valuation. And you'll have investors who will come in and give you a little money to get to the next level and then see how it goes from there. So I think that whatever the financial projections say about the value of your money, that's not what people are going to pay for today. Because everything else, all the money that comes in is going to help you make that occur. And you don't have that funding right now.
Jill, I'm sorry to jump in, but the pro forma question is one that we get a lot, especially for early stage companies. And I'd just like to sort of match up with what Catherine was saying, is the numbers aren't as relevant as the manner in which you're thinking about those numbers. So if your acquisition strategy is we're going to have 1 million users in a month, then we need to see a ton of marketing money. Or we also probably need to see a bunch of money in customer service, because you're going to get a lot of phone calls depending on the kind of business you are, emails. So it's really pro forma. Catherine said it perfectly. We know that the end numbers are incorrect. It's much more important about how you're thinking about building your company quarter over quarter that we're really looking at as we look at pro forma.
Right, and that tells you how you're right now thinking about managing the business. Okay, what's in your head in terms of managing the business? And I do think that's really critical.
Thank you both. Kind of related to going back to financial projections, is it a good idea to provide a best case and worst case financial projection, or is that something you don't prefer to see?
I've seen, the forecast case, the best and the worst case from different companies, and we're always going back to this. What does it say about the thinking? Okay, and it can give you an upper band and a lower band. I'm mixed on that. If it's there, it's there. It'll be interesting to look at because it tells us, what do you think the weaknesses in the forecast are? Is it going to be demand from someone? Is it going to be a bottleneck in manufacturing? What makes the worst case the worst case? What makes the best case the best case?
Okay. You had mentioned earlier the fact that if someone comes to you and wants to offer a safe investment, you smile and say and politely decline. What have you, or will you, or would you do if a company that has gotten a prior investment with a safe comes to you for follow-on funding?
We would go to them and see about a priced round. Okay, the safe doesn't continue. The safe was for that first investors round, and if they have a lead investor for the next round, one would assume it would be a priced round.
Okay, those were all the questions that I have been seeing. I think one more final iteration. There was a question earlier, but then after that, you kind of talked to it. But if you could just talk about the kinds of things that you do when you work with a company after you've made the investment, because I think that's, it bears repeating how important that is. That really the money is probably, when it all comes down to it, it is of less value than the rest of it. So if you wouldn't mind kind of finishing with that, because we're very close to the end of our time. So I'll ask you to do that, and then we will wrap up for the morning.
Sure. If we're the lead investor, or even if we're coming in separately, sometimes we have a board seat, sometimes we have an observer seat on a board. So we're connected into the company in terms of the operational information. So what the company needs, they're going to identify what they need, or even what the investors think they need in terms of the next level of help. It could be doors open for introductions. It could be somebody's doing a manufacturing process and they need some manufacturing help. Maybe we can connect them to other people who've done this. And that sort of stays, especially if we have an observer seat or as a board seat. We're in there seeing the operations. We're seeing, if sales are going well, if sales are not going well, what's the change? What can we do to help? I mean, that's that question. What can you do to help? And so the introductions to potential clients, to potential customers of the company, introductions to other funders also is very important. And I think, and that process continues if we're on the board. It can continue informally if we have certain expertise in the business that the CEO and the team wants to take advantage of. We've got a bunch of guys who do supply chain management and can connect people into other kinds of software and connections. It just varies by company.
We've gotten a couple of other questions now. The first is, would you define what you mean by a priced round?
Okay. A priced round is an equity investment which says the value of your company today is $2 million, and the investors are investing X number of dollars for X number of shares at that valuation. Okay, so that's what a priced round is. And it is a direct equity investment. The other side of this is a convertible note, which is a note which says I'm investing in a vehicle which is a debt vehicle, which may have a cap on it, which is sort of a different way of looking at a price, a cap of which, when we convert this equity round, you as the investor will get shares at a 20% discount to the valuation of whatever the round closes at. So that's just a promise of a different movable share. Okay, so pretty straightforward, I think.
Okay. Another question: does your group expect that a company coming looking for investment from you, will they need to have a full business plan at the point where they approach you?
Full business plans are not as common to be submitted these days to different operations, to different investors, but you need a plan of some sort that you can describe. So the more I talked about the assumptions in a plan, the assumptions in the financials, whether you think you have a plan or not, if you're doing financials, you've got some kind of assumptions. And being able to show those assumptions, that really describes what's going on. And also too, who are my customers? Who am I going to exit to? All of these great questions need to be answered before you come talk to an investor, at least, to see where you see the lay of the land. That's really important, because we're not investing in the shiny object. We're investing in what that shiny object allows you to create as a company and where that company is going to go.
Okay, thank you very much.
Can I have one comment, Jill?
Go ahead.
I wanted to talk about term sheets for a minute, since the last couple of questions were term sheets. Sometimes we see where a company has gone and paid an attorney to create a term sheet, okay, and saying this is what we're raising funds on. And it doesn't have any investor input, so it's not of interest to an investor coming in. But also, too, sometimes those term sheets have been used with friends and family at the beginning of a raise. And I think one of the disservices that early stage companies can do to their friends and family is to create a priced round. I've seen it where people who invest in you at friends and family love you. They don't know anything about the business. You say, mom and dad, the business is worth $10 million. They say, fine, give you money at that valuation. A real investor comes in and says, this is a $3 million business. So all of your friends and family have to take the term of art as a haircut on the valuation. And you'd be much better off when you bring in friends and family to do a convertible note. This says at the next round, okay, we will price it at some discount to it. So you don't ever leave your friends and family hanging with a really bad valuation that has to be cut back when you have real investors come into the deal. So just a word of warning. That's all I wanted to answer.
Thank you. That's really important for all of our audience to hear. I think we're at the point where we have answered all the questions that everyone has, and we are running up on our hour. So I thank you all for your participation. Catherine ONeal, thank you so much for your time and your expertise and your willingness to share it with our audience. Brian, thank you very much for your comments and for moderating the discussion with Catherine. As I mentioned earlier, we have recorded today's session, and we will be sending that link out to all of you along with the website URL for Jumpstart. And we thank you very much for your time today. And stay tuned. We will be doing this again, so probably after Labor Day, or thereabouts, you will be hearing about our next session. So once again, thank you all for your time and your attention today.
Thank you very much. I really enjoyed it.